Hey guys, welcome to episode 1 of Reading the Tape and really reading the tape. So, like always, every trading day, we only look at two main timing windows, which starts right at 3 a.m. and ends at 5 a.m. We could extend it a little bit further if we're being honest, but we don't really have to. We want to reduce it down also based on the focus of things. You really want to put all your effort on all your focus onto a max 2 hour timing window because that's really when you the longest amount of time that you can actually really perform. So this is going to be our London timing window. And then for New York, we're going to be looking at 9:30 a.m. until 11 a.m. And I'm not saying that there's nothing happening outside these timing windows. There's a lot of stuff going on, but it won't be worth our attention, if you know what I mean. So let's look at those two timing windows very specifically. Of course, we analyze what's happening during Asia, but with this concept, the main idea is to really just focus on that one session, and everything else outside of that can really be filtered out. So let's get started. London opens up at the high of the day, right here. I mean, Asia just trended to the upside. Not that we have to know, we just follow along with price action. Of course, during London, we can't just blank it out. I mean, we could, but then we cannot anticipate a London Open move, for example. If we were only to look at what's happening inside the session and do not take anything into consideration, let's say, for example, a fair value gap prior to the London Open, well, then we would look at price action this way. We see price returned or retraced a little bit at the beginning of the new hourly candle. Always think in terms of a new hourly candle. So the new hourly candle opened up right here. We retraced likely into a higher time frame inefficiency on the 15-minute maybe. And then at 3:25 with that new 30-minute, 15-minute candle, halfway mark to 4 a.m., this would always mark the middle point of our timing window. So we have 3 a.m., 4 a.m., 5 a.m. You can see that price formed a higher high. So right here, we formed the higher high. And then eventually, with that new hourly timing, new hour candle opened up. And this time, instead of pushing to the downside, we pushed to the upside. And I'm not saying that you're going to take a short like this with the methodology that I use or that I teach, where you have 0 ticks of drawdown and catch the perfect top and get out at the perfect low on that next hour. That's not what I'm trying to talk about here. We use fair value gaps within this timing window to make sense out of price action. In this case, I like to always look at the most recent bullish fair value gap. Here we've been going up, so we're looking at bullish fair value gaps. Also on the 5-minute time frame. We could drop this down to the 1-minute time frame, but it's much, much, much simpler on the 5-minute. Yet the opportunities won't have the same risk to reward ratio, so just keep that in mind. We have a unfilled volume imbalance in here, so we didn't retrace and fill that in immediately, but eventually we always come back to get them. So I like to extend those out. We close eventually below our highest bullish fair value gap and even below this bullish fair value gap. So this is my first entry signal just within this timing window. So we have our inversion fair value gap right here too, actually. And right here on this candle close, I'm trying to get my entry. Once I see this candle close, I'm immediately in a trade. I enter with a market order. I'm preparing myself for a potential retracement. So here in this case, just by simply using common sense and ICT concepts, this would be our breaker block. So we could place a limit order right here, or you could also do market executions as we retrace. On that very next candle, once again, we leave behind a volume imbalance, so I would be marking that one out as well. So right here, we leave behind that volume imbalance. Right here and there. And right now, price is not telling us that it wants to continue higher. So we have to erase that idea completely and not be afraid of price moving back to the upside, because that would, lower our, how do we say, lower our chances really, because if you're afraid that this might not work out, you won't be able to fully capitalize on it. And this is during the London session. So we drop lower, leave behind a bearish fair value gap now, right as well. So that's our next confirmation. We already left a fair value gap above right here. We don't always get into that highest bearish fair value gap, so I'm not waiting and placing my limit order based on the market structure shift up here. I know that most of the times that simply won't get filled. So we have our bearish fair value gap, bearish volume imbalance, 2 inversion fair value gaps, and this one right here. So what are we going to target? Of course, that's the next important question. That's why I have the VWAP baseline. That's why I'm calling it a baseline as my main objective. If we're coming from the high of the day, I look forward to see a retracement around to the VWAP. I'm not targeting perfectly the VWAP. I look for other confluences in terms of profit taking. Of course, eventually, you're going to catch that high of the day, but we're not really out to seek that high of the day. You can always leave a little running position open, let's say 10% of the trade or 25% of a specific entry of your total risk. But the main idea is just to target low-hanging fruit objectives and get done. And therefore I like to use short-term lows. So right here, you can see if we were to imagine a higher time frame, we move to the upside, forming a higher low. And this is also, important to have that higher time frame bias in mind. If you're bullish on the hourly time frame or on the higher time frame, yet you spot a short opportunity, it's still worthwhile taking. But simply don't expect it to run out the entire high of the day. Higher high, higher low, higher high, higher low, higher high, and then we shift structure right here. So at this point in time, knowing that we likely won't get the ideal entry opportunity right here with this aggressive move, the intention of this aggressive move is to hunt stops efficiently and very quickly. And stops are placed below each and every single one of these higher lows. So let's see, right here and there, below each and every single one of these higher lows. So while we're getting into the short, I'm already planning on where I'm getting out, of course. And you could also simply keep on holding on to the trade. Make sure to secure some low-hanging fruit targets and partials. And let the rest run. For example, right here we have a bullish fair value gap that has been used as support before. And then we see, let me actually turn that into a bullish fair value gap. Then we actually see it closing and opening below this bullish fair value gap. So that's a good sign. It's 455, but with that new hourly candle, what did we actually get here? Well, a pin bar candle to the upside, and that's price telling you, mate, I don't want to continue lower. I just approximately hit the VWAP, took out a short-term low, and now I'm pushing to the upside. So this would be your exit signal almost. You could wait for that next candle, and that next candle invalidated the entire setup right here. This is when you could almost start to go long again, because what do? We have one bearish fair value gap here, a lower low, a short-term high, and another lower low. And now we're closing above that. So this is our bullish market structure shift to the upside, really. with our market structure shift up, we come back to retest the inversion fair value gap of this bearish fair value gap and continue to the upside, targeting our first short-term high. Once we hit that, we leave behind a inefficiency. We end up holding support here and continue to push above our final buy side target right here and there. So as you can see, this also works outside of the kill zones, but you just cannot focus for that amount of time. So right here, bullish fair value gap after retesting the inversion. And once one of those fair value gaps that we use to frame our buyers are invalidated, we can pretty much scratch the entire idea and immediately start to take off some risk. So right here, we could have entered short immediately on this close, and then we continue lower. Okay, we take out that first low. We see we leave behind inefficiencies. We're very likely going to fill them most of the time. Sometimes we also just run. I'm going to show you more examples of the scenarios where we are just going to run. We saw it this week as well. But this is how you can scale into the entry opportunity, because you know with high conviction that we are out to hunt stops, and stops are right here and right here and right here. Ideally, if we completely melt and get below the VWAP, we could even target this, but you're most of the time better off looking for low-hanging fruit targets, securing the majority of your profits, moving your stop to break even, and then just following price action, because with that new hourly candle, things can change. And right here on this candle close, once we close above our lowest bearish fair value gap, so right here we close below our highest bullish fair value gap, our highest two bullish fair value gaps, leaving behind bearish fair value gaps. We recognize that, we enter short, target short-term lows, but we also recognize that once that starts to shift, which it did right here, we could theoretically immediately enter long and slowly follow price action. So we retest, we continue higher, wick to the downside, but like always, bodies tell the story. We hit our first short-term high. That's where we take partials, move our stop to break even. Our entry would be right here. Move our stop to break even. Okay, we leave behind a bullish fair value gap. Let's see if with the remainder of the position, if this actually, is good enough to hold, because A, we just hit this bearish fair value gap and this bearish fair value gap. We're not too worried about this, because all we care is that right now we're in bullish order flow. Same as we are right here. We're in bearish order flow. We look for lower prices, but we shifted right here and we're starting to respect bullish order flow. So now I'm looking forward to see if that bullish order flow can continue. So bullish fair value gap, I want to see if that can hold support. We even had a unfilled volume imbalance right here. With unfilled volume imbalance, let me get rid of most of those drawings here so everything's nice and clean. There we actually go. We retrace into it. We don't tap this unfilled volume imbalance, but once we would have seen, and note here exactly, this is not, you will see in the following examples, this is not some random theory of mine. This is actually working, at least on ES it is, that laser sharp precision. If I would have seen a close below this bullish fair value gap and this volume imbalance right here, so let's say this is 4916.75, and we would have seen the close one tick below, this could have been your exit and you would still be in profit, because if this fails, well, we're reacting off a bearish fair value gap right here. And now, bullish order flow, by that I mean bullish fair value gaps and bullish volume imbalances, fail to hold price, talking about candle bodies, well, chances are not the best anymore. And that's usually when you can start to take off risk, in case you're not in profit yet. But if you're already in profit, it's always a good idea to, secure most of your profits. We already secured some profits above this short-term high. We're not here to swing trade or anything, or let price run into daily targets. We're here to scalp. We scalp our points. And eventually we see, okay, it holds support. So what do? We continue. Okay, takes a little bit longer than we really want to. Right now it's already 6 a.m. and the longer we spend in front of the charts, the more emotionally depleted we become and the more likely we are to make mistakes. That's why I like to reduce it down. We don't leave behind any bullish fair value gaps anymore, but slowly but surely we continue to the upside and take out buy side liquidity. So let's actually see what happens after that. Let me get rid of all these orange lines. So this is our timing window, but we see that outside of this timing window it still works. We could argue the same, that we could anticipate what's happening with the London Open right at the open. We have a volume imbalance right here. Of course, it's harder to pick which one price is going to react off, especially if we, let's say, have multiples of them. We had a bullish fair value gap right here that ended up holding support. Left behind a bullish volume imbalance right here and a bullish volume imbalance right here. Those are all the signatures we have right now. We have a low right there. If this should all fail, well, we have more targets to the downside. But it's easier to just focus and see and frame the narrative for what's happening within this timing window instead of trying to predict. Or that London Open move, most of the time for me, especially looking at this timing window, is most of the time just a prediction / gut feeling. Reading the story, okay, we're in bullish order flow. Let's just see if that can continue. And yeah, that win rate is actually pretty good. You can see that every day on our daily tape reading live streams. But that's not the point that I'm trying to make. Let's continue here once we take out buy side. Also note the timing here. Always be aware of the new hourly opens. Actually didn't want to spend too much time outside the kill zone because, like I said, emotional depletion. We can't act like robots for 24/7 per day. We're still human beings. So let's actually focus on the New York session now. New York session, 9:30 until 11:30. Let's do a 2-hour timing window. We could also do 9 a.m. or 9:15 until 11:15 to cover 2 hours and maybe even catch the London or New York Open move. Alright, so what happens here? We retest the VWAP and that's when our timing window starts. On the 5-minute time frame, we do not leave behind bullish fair value gaps at this point in time. 9:15, 9:20, 9:25. Okay, what do we have here? We have something. We have a unfilled volume imbalance and we have a inversion fair value gap right there. So let's actually see how that would have worked out. Prior to the New York Open, we close above a bearish fair value gap, turning it into a inversion fair value gap. We leave behind a unfilled volume imbalance right there. And what do we do with it? Well, we're in bullish order flow. We're just bouncing off the VWAP. Where's buy side? Right here. And right here. And even look at that. With that New York Open, so prior to the New York Open, of course, we don't actually see what's going on there. We only see what's left to the chart. And what do we see? We have buy side liquidity above. We have a unfilled volume imbalance right here from 7:30 to 7:35. We have a unfilled volume imbalance right here. What is price telling us at that time? Well, we're coming off the VWAP. If we want to continue lower, well, we would use this bearish fair value gap to actually continue lower and not start to leave behind bullish price signatures. But that's exactly what we do. We close above at 9:25. That's 5 minutes prior to the New York Open. And this could have told you all you need to know. Set your buy limit order on the inversion, on this unfilled volume imbalance, your stops. Of course, open volatility doesn't always mean that you don't get wigged out. Wicks to the damage, bodies tell the story, and the bodies told the story here. I always use a safety stop loss, that's what I like to call it, which would have been below this low. So this is what the trade, for example, could have looked like. One right here. We just look for a quick scalp with the New York Open. Stop loss right here for a 1-to-1 risk reward. high probability in my eyes. 3.5 points. Cannot complain if you use proper risk on that. You can actually play that, and if you set another limit order down here on that unfilled volume imbalance, well, almost 5 points. If you wait for the tick above buy side liquidity, well, that's a 2.2 risk to reward ratio. That's not bad. Just by looking at something that happened within our timing window. Let me actually delete these orange lines. And then, of course, the tape read continues, like always. So, within our timing window, we anticipated the short right here. We target close liquidity, safety stops, usually at the swing high, but that's just a safety stop. If we would have immediately seen price closing above this bearish fair value gap, back above the first inversion fair value gap, well, we could have already started to take off some risk. And once we see the close above this, well, I don't know, that immediately invalidates the entire idea, and then it's starting to look more like this could actually be a turtle soup setup where we sweep a short-term low and then eventually still continue to move to the upside, and those are going to be your losing trades. But that's why risk management is so important. 1-to-1 risk to reward ratio is usually what I would go for. 1-to-1 risk to reward, I know we have the VWAP below, and I would stack another position right here on this inversion fair value gap. If you want to spike your risk to reward ratio, you can also do that. Take profit at the same place, just below sell side liquidity. You can see that, okay, we took sell side, we leave behind a bearish fair value gap. Will this bearish fair value gap hold resistance? Yes, it did, delivered into our target, but eventually it didn't. And even if you missed to take profit here, this would have been your clear exit sign. All right, let's see. New York just opened up, volume imbalance. We do not leave behind a new bullish fair value gap. We already secured a quick New York open scalp in that style. We have this volume imbalance right here. That's already been filled. Could still be used to reference later. And what do we actually do? We go sideways first because that was that first main objective. Take out the high of day. Consolidate, leave behind equal highs. Come back to what? Take short-term lows right here with a lower high to the left, a higher low to the left, and a higher low to the right. So a wick on its own right here. We take that out and we have equal high buy side, and boom, there we go. So once we take out that high, note the timing 10:15, we push to the upside with a bullish volume imbalance. We don't just blindly, we can of course use this bullish volume imbalance as an entry opportunity for a super scalp, but I don't want to get into that now. That's something for the live streams. The more important thing is that I want to see if this can continue higher. We already saw our scalp. Otherwise, we could have played the inversion fair value gap a couple of times into equal high buy side liquidity. But because we're more sort of we react to price action and interpret it by using fair value gaps. Well, what's happening right here? We take buy side, we're at the high of the day, undoubtedly the high of the day, and we shift structure right here. We don't close below it yet, but I'm not too picky with that in terms of the market structure shift. I'm only very picky with it when I'm looking at my fair value gaps if we close above below them, because it's always a great indication. But what's happening here? 10:20, we immediately dump down, hit the VWAP again. What do we leave behind? Relatively big, but well, sometimes we are here to react. We're not here to... You can still decide if you want to take that opportunity or not. Bearish fair value gap right here, that's what we leave behind. We didn't close below the inversion, and this is actually our first fair value gap that we left behind since the New York Open, at least on a 5-minute time frame. We get our first entry on our bearish fair value gap, place our stop at the high with 6 points. And what do we target? Short-term lows. Higher time frame might be bullish. I don't care. I want to be out. I'm not looking forward to catch that insane 100 risk reward trade. We have sell side liquidity right here as well, so this would have also been a good target. But mainly that 1-to-1 risk reward ratio of this entry, which would have been missed here, but also only because we took the entry right at the exact low. At this level right here, 915, would have already had to secure some profits. This is scalping, and especially if the fair value gap candle or the candle that creates or leaves behind the fair value gap is this huge, well, for a fixed risk reward ratio of 2-to-1, your take profit target would be the Asia session low. But there's no point in placing a blind take profit target, in my opinion. So what we do is simply looking for low-hanging fruit targets most of the time. That's what works best in the end of the day. Also, basing it on a risk to reward ratio and always putting your stop loss at the high really doesn't allow you to take full advantage of the opportunities presented. So I think a more suitable approach, I mean, of course, safety stop loss right up here. If we close above this bearish share value gap, we can get out earlier without taking too much of a, if we risk 1% here and we get out here, we might have only lost 80% of our entire risk. And over time, that's going to save you a lot of money. That's the interesting part. And we don't always have to get in at the low of the fair value gap. This is just the initial thought. I mean, we get in there and then potentially place our limit orders right where? At the 50% of a fair value gap. Here we really don't have inversion fair value gaps, volume imbalances to use on this price leg. So we simply can't. But we like to add to our trades. You don't, for example, risk management is very diverse. You could use 50% at the low of your fair value gap, especially if it's a big fair value gap. Then you immediately switch to your plan. Okay, this fair value gap is too big to risk 1% at the low. Risk to reward ratio into my low hanging fruit targets is less than a 1-to-1 if I place my stop at the high of the wick. So I would prefer to actually get another entry if I can on a deeper retracement, or you just wait before you hit that market order. Place your limit order here if you trade futures, and this would already have netted a 1.5 risk to reward ratio just into that lowest target right here. Those ones actually your lowest targets. This is a pretty good target. You know what I mean. So those would have been your two scalps during the New York AM session on that specific trading day, netting at least 1.5 risk to reward. Pretty good day, wouldn't complain about it. And once we hit that sell side, we see, okay, we fail to continue lower. We push. We, once again, don't leave behind a 5-minute time frame bearish fair value gap. So we don't have much to react on. But we simply can see that, okay, right now, price is turning around. And what is it leaving behind? Right here, still within our 11:05 new hour timing window. A bullish volume imbalance right here. Pin bar, wick to the downside. Big bullish not big bullish candle, but you know what I mean. No wick to the upside. That's a pin bar. Bullish fair value gap right here. We retrace, we hold support, wicks to the damage, bodies tell the story. If you want to engage on something like that, you place your limit order right here. Your safety stop loss right at the low, or maybe the 50% of this wick. So something like this, yep. And you simply target that closest short-term high right here, and already that's a 1.5 risk to reward. And then you leave something to run for potential buy side again. Of course, that kind of a little bit depends on your higher time frame bias and the overall trend on the higher time frame. The trend right now is bullish on the higher time frame here on the S&P 500. That's why we would preferably look for longs and don't always hold on to our shorts with the market structure shifts, our 2022 models, because in a strong uptrend, well, they don't always play out. Maybe sometimes combined with news and you still had your huge risk rewards, but that's not what I'm out here to do. I'm looking for my easy entry opportunities and trying to profit based on them. So that's our entire Monday. And then after 11 a.m. I usually stop trading because price is moving pretty quickly and you have to be quick and think right, control your emotions in order to get in on these opportunities. And don't fade your bias, of course. And after that, you're already depleted. You made some profit, or you either made some loss or profit. If you made a loss, doesn't matter. If you made a win, doesn't matter. It's a good practice to stop after that 2-hour timing window and really try to perfect it within that timing window. Let's actually also place the halfway mark, which would be 10:15, from 9:15 to 10:15. If we just look at the New York Open, or here with the New York Open, it's a little bit more tricky. We start at 3 a.m. during London and ended at 5 a.m. So we have a new hourly candle right in the middle of it. Here, the main focus is that new 4-hour candle at 10 a.m. And that's actually what we had right here at 10 a.m. Manipulation to the downside, taking a short-term low, bouncing off our inversion fair value gap, pushing back above the previous 4-hour time frame high. Once we got above it, we smacked back down, leaving behind an inefficiency, targeting the other end of that 4-hour candle. Very simple, actually. You just have to, try to, how do we say that? Get a good idea of what's going on the higher time frame and simply develop a feeling for it. Later during the PM session, 1 p.m., I wouldn't be trading anything in between here. I mean, we can see we took out the high of the day again, not leaving behind any bullish fair value gaps, and then we turn around from the high of the day, leaving behind a bearish fair value gap. But at that time, we already hit a short-term low. Of course, we could simply anticipate that off this bearish fair value gap, we want to see lower prices, and I think I actually have done this week for the PM session, looking for lower prices. So this is an example that failed, and it's actually very good for me to show you that. So we have our bearish fair value gap, we enter short, safety stop loss at our high. It doesn't mean we wait to be stopped out there, because price tells us what it wants to do. The interesting part here is, okay, we already took equal low sell side with this drop. We could look for that continuation into our next short-term low, which would perfectly line up with the VWAP here. Next short-term low and equal low sell side right here, and the London session low right here, basically. That's what we could target eventually for a good risk to reward opportunity. But of course, like I said, higher time frame is massively bullish right now. So we have to be aware that if we short, we have to be more careful. We would prefer longs and simply trade with the trend. What did price do here? Took sell side liquidity, leaving behind equal lows one more time. But it really didn't show us that it wants to continue lower. If it would have wanted to continue lower, trust me, it would have done it. It would have continued lower. What's happening right here? 1:20 p.m. We close above our bearish fair value gap. So this is our exit, or my exit at least. Sometimes it's hard to actually close the entire position, especially when we're in loss, but that's just good practice in terms of risk management. Sometimes I'd say 1 to 2 out of 10 times we close above, but we still manage to continue lower. If we close back below, we can always re-enter. Our risk to reward ratio won't be the best anymore, but you get the idea. It doesn't always have to be that best risk to reward. We're simply listening to what price is telling us. So this would have been a losing trade if you didn't manage to get out at this candle's high. Well, we didn't continue immediately lower. Instead, we formed a candle with no wick to the downside, pushing further up. If you don't get out at this point in time at 75% of your entire risk, well, then you just couldn't let go, still hoping. No wick to the downside. Previous candle was a pin bar. Candles tell us what they want to do. So after closing above and taking the loss right here, minimal loss, so of the entire risk, 4.5 points roughly, we lost 1.5 points, so that's a quarter, a third actually, of our entire risk. That's perfectly fine. We can take that. We had good targets, equal low sell side, but unfortunately that didn't play out. Alright, but what's happening now? If price is closing above a bearish fair value gap after taking some sort of a sell side liquidity pool, this equal low sell side right here, and failing to continue lower, instead going sideways, closing above, pushing higher, and what is it leaving behind now? Sorry, let me actually use the proper rectangle right here. It's leaving behind not just one, but two bullish fair value gaps right here and there. And we also have our inversion fair value gap right here. So this is now in place to support price. We have two bullish fair value gaps and one inversion fair value gap. And I know we closed below the highest bullish fair value gap. Doesn't have to mean much, because we immediately below the highest bullish fair value gap have another bullish fair value gap, and then the inversion fair value gap. You can take off some risk if you don't like what's going on here. Also note the time here, 1:50 p.m., 1:55, and then at 2 p.m., beginning of the London PM session, New York PM session, we actually start to push back to the upside. So this is just indiscrepancy. If this candle would have closed, this is just experience at this point, I guess. If this candle, instead of closing right here, would have closed below both bullish fair value gaps, this would have been a different story. Or if it would have even closed below this inversion fair value gap, this would have confirmed the short to me into equal low sell side liquidity all over the place. It didn't do that. So at this point in time, we just have to remain calm and collected and simply know that, okay, we can play this long here as long as we respect this overall area. As long as we respect this area with the two bullish fair value gaps paired with the inversion, we can stay easily within this trade. If we start to fail to hold both bullish fair value gaps, we could take off 50%. And once we close below our inversion fair value gap, we could either flip our position to quickly target sell side liquidity if we haven't done that already with a big wick prior to the new hourly candle. And then my main focus is, okay, we're holding support here, order flow is bullish. I want to see if I'm long here. I want to see if price can push back above this bearish fair value gap. Once it does that, then, well, you can add to your position, target this short-term high. At this point in time, that's really easy. We have our volume imbalance right here. We close above our bearish fair value gap. We got above that. Of course, at this point in time, you might be doubtful that we're gonna continue higher, but my main point right here would be that price didn't take out any significant buy-side liquidity first, and it likes to do that first before showing candles or presenting candles like we saw here during the AM session at 10:20. We took out equal high buy-side and we're at the high of the day. Here, we're not at the high of the day. We didn't take out even this high right there. No equal high buy-side liquidity. We took out a short-term high right there, yeah, but we still have reason to believe, as long as we hold here, that we're going to hold here, even though we have that bearish fair value gap. But this is one of the more complicated and complex setups. I hope you understand that. So, inversion fair value gap, we push above that higher time frame. We know that we are in extreme bullish order flow, and then we're just pushing further and further to the upside towards our all-time high, leaving behind 2 new bullish fair value gaps, actually never coming back to retrace into them. And then at 3 p.m. this was really interesting on Monday. Yeah, we just exploded to the upside. I was in this trade. My main target was Friday's high and the previous week's high actually. So I got long right around here, added to the position once we invalidated the bearish fair value gap, targeting this buy side liquidity right there, taking off most of my position right here because the new hourly opening was coming up. And yeah, should have trusted it more at that point in time, taking profits right here. Majority of my profits at the previous day's high. So this is Monday at Friday's high / the previous week's high. This is why it's a red line with shades of yellow or orange, because they're both combined. Open up with a bullish volume imbalance, and we just pushed through it and never left it. Continue to push, leaving behind a bullish volume imbalance, filling it in, continuing higher, leaving, at this point in time, I'm usually not trading anymore. This is the late power hour between 3 and 4 p.m. New York local time. But once again, we leave behind a bullish fair value gap. We hold support, highest bullish fair value gap, failing to take out the high. This is just too late for me to trade. At 4 p.m. the market is closing. And then, you usually get aftermarket close pushes like we saw on Tuesday. But I hope this recap of the price action step by step on what we saw on Monday, even though we didn't have huge swings and insane risk reward targets, I hope you understand that with this method, you can easily scalp your couple of points, and even with risk to reward and good risk management, even more. I mean, right here, this could have been a 10-point move into a very obvious buy side liquidity target. If that's not obvious, I don't know what is. Right here, now I actually remember, this is where I took partials, in case we're not going to run into the previous day's high right here. Already getting in relatively low, adding to my position. At this point in time, I was already up more than 5 points. Moving my stop loss to break even. Safety stop loss, like always. Well, you could pick any of the lows. That's really up to your own decision, how you want to base your risk management on. Some people prefer really tight stops, and they place it just one tick below the area that they want to see ending up holding support, but then you can't really complain about getting wicked out. That's what wicks are there for. They do the damage. That's why it's more risky to take trades right with the New York Open or anticipate what the New York Open is going to do. Same goes for the London Open and news candles, for example, because they end up doing the damage. That's why I like to give it room, even though it might lower my risk reward ratio. I'm not a big fan of getting wicked out of a trade. This is my safety stop loss, where I would, for example, lose 1% of my equity in case that it's going to be hit, like with every other strategy out there, but with a twist that once I see it's closing below, I can get out, let's say, for example, below 50% of my planned risk, and I saved myself a lot here. Most of the time, depending on the volatility, of course, we get the close below, sometimes very in close proximity to our area that we wanted to see, holding support. If we have that long bias and if we followed along with price correctly, sometimes, it just drops and hits our safety stop with big candles like this or with huge wicks, depending on news, depending on volatility. But that's why we have those safety stop. Sometimes it's closing very closely to your safety stop, but you take a smaller loss. And this is actually a agile methodology that helps you closing your positions earlier based on price action and based on fair value gaps in the end of the day. So we took a little loss right here because we anticipated the continuation lower into potential more sell-side liquidity. That's what I did as well. But once we saw the invalidation, we actually get out without waiting for our safety stop to be hit all the way up here. In that case, we would have actually missed that long opportunity. So I hope you really learned something from this in-depth analysis on what we saw here on Monday. Main point is really to restrict it to specific timing windows. If you're from America and you cannot trade the London session, well, do the PM session. Start at 1 p.m. right here. That's why I went short here, 1 p.m. I see bearish fair value gaps, short-term lows to target, equal low sell side, equal low sell side, equal low sell side. PM session from the high of the day, I took a lower risk than usual because we still have buy side above. The overall higher time frame trend is bullish. So I apply less risk on my shorts and more risk on my longs. The best long opportunity in my eyes happened then within this timing window if we regard it from 1 p.m. all the way over to 3 p.m. Once again, a 2-hour timing window. So if you cannot trade London, you would trade the AM session and then afterwards the PM session. And very similar to what I explained at the beginning, anticipating what's happening at the beginning of your session is harder than reacting to something that sets up within your session. So for example, right here within this timing window, the long would have been your only play. If you look at what happened before and you anticipate what's going to happen at the beginning of your timing window, well, not saying that it's not always going to play out. Everything has a win rate and it comes down to risk management in the end of the day. But it also requires a little bit more patience to actually wait for your setup within your timing window and not just jump the gun. But that's similar for every other strategy, methodology, system out there. So I hope this, like I said, recap of Monday's price action with my in-depth analysis helped. I'm gonna share it only with the VIP members, or if you actually want to see me do this live, because those are all trades that I actually took. I shared that all on Discord. PM session executions with that long into the previous week's high, previous day's high, the London session short, and the New York AM session. What trade that I took here? So definitely that short into sell side liquidity. I think I had lower targets, but I took off the majority after 5 points on the take profit trader challenge. I didn't anticipate. I don't really play the New York Open on the 5-minute time frame because of the potential volatility. But this is just what could have been done, disregarding everything that happened outside the kill zones, like this potential long right here, safety stop loss right here, target buy side liquidity and short-term highs on the way to that final buy side liquidity. Done. You don't have to worry or spend too much time within a trade. That's just costing, at least for me, too much mental equity. The inversion fair value gap right here, right after 5 a.m. Safety stop loss right here. Final target right there. Let's move it over here. Re-adding to your position right here on this bullish fair value gap. And if we would have seen the early invalidation, okay, we just had a little bit of a new hour fake out / manipulation right here. If I zoom in once more. A new hour fake out. We push to the upside and actually close above the bearish fair value gap. Well, in that case, we would have closed somewhere. Now we actually had a bullish fair value gap just below it, so we could have used that as potential framework. That once we close below that area, below this bullish fair value gap, we could get out of the trade. Really nice. But the hardest point is that you have to be able to quiet everything else and just solely focus on price action and develop that feeling for your fair value gaps and frame your narrative, because at this point in time, you're very likely still with parts of your position short if you didn't end up taking profit, and then switching bullish right away. It's one of the hardest things, because once we look at price action, our mind usually likes to fixate on one scenario over the other. And if you're already short, our mind or our brain likes to, or we as traders, we like to blend out everything that goes against the potential setup that we have on our charts. So that's one of the hardest things that you have to overcome with time. All right, so like I said, I hope you have learned something from this recap. This is actually 50 minutes long. I decided to do it because I low-key was a little bit bored. You see the opportunities, low-hanging fruit targets, nice buy-side liquidity targets. We don't hang around in trades forever. I don't like that. I'm a scalper by nature, and this is my unique approach. Of course, if you have any questions, feel free to ask me in the VIP chat. Take care and enjoy the rest of your day. Bye.